Hey traders, welcome to Charts and Coffee, Non-Farm Payroll Edition. We're taking a look at the action after the NFP has come out. We shot straight up on the data and just sort of hovering and waiting for just either gravity to kick back in or the continuation. That's the fun part of trading, right? We always got to ask ourselves, what of the three reactions are we going to see at the different levels we're watching? Acceleration, a stall and or reversal, right? And so depending on at this point, once the bell rings, when I'm looking at the NASDAQ now, forgetting non-farm, right? Just looking at NAS at 9:01 a.m. Eastern, 29 minutes before the bell rings, there's a few basic things that we can see. First of all, we're trading above the previous session close. That's always going to be something that I'll take note of, and we can definitely see we're trading above that previous session close. So, all right, that's the first thing. The second thing is this is the NASDAQ specifically, and this is the one that whether this was the top tier Outlook newsletter or whether this was any number of the videos that we've cut over the past few weeks, not all the indices are sitting in the same place in terms of potential bullishness to each other. The main key here is that the NASDAQ remains neutral and above the 200 exponential. The main sectors in the NASDAQ, we got really four if you want to look at it that way. Definitely the top two are XLK and XLC. So think Apple, Microsoft, Meta, Google. Those also are in that same spot. So the cylinders within this engine that we call the NASDAQ are bullish. The NASDAQ itself is bullish. SMH would sort of be the honorary fourth sector of weighting. But let me show you the S&P. And I think something that's really important also to mention is I look at the S&P last, right? S&P's up, it's doing a very similar thing. But I look at the S&P last, which is to say, when I'm looking at this, I look at the S&P from the standpoint of, and I know the time is blocking the clock here. Let me move this over. I look at this from the standpoint of, is tech moving higher? Are financials moving higher? And is healthcare moving higher? And that's definitely something I need to consider before ever being too bullish the S&P. Again, the three cylinders there, tech, financials, healthcare, it's the same thing for the Dow, by the way. It's the same thing for the Dow. And ultimately, with the Dow, the order is going to be different, right? It's going to be looking at the Dow from the perspective of financials, tech, and then healthcare, as opposed to the S&P where it's tech, financials, healthcare. And one of the things we talked about yesterday, because we had a long position in the SPY, this was a big trade yesterday for us. Why the SPY? Well, all my cards on the table. We got into the QQQ. QQQ was pretty topsy-turvy. Stopped me out at a 15% premium loss. All right. So I paid for every dollar I paid for premium, I lost 15 cents. Very recoverable. No revenge trading trigger, right? Goes off with that. The thing that SPY then started to show in terms of relative outperformance was the fact that XLK was strong and XLF was. And on those days, on sessions where tech is strong and financials are strong, the S&P has the potential to outperform. When the financials are strong and if financials are even stronger than the tech, if XLF is stronger than XLK, then the Dow has the ability to potentially outperform. So which one of those cylinders is firing and firing best is going to make a huge, huge difference. All right, so that's what we've got here this morning. Let's jump into the questions. First up is Drew. At what point is good news good and bad news bad? Great question. So Drew, when we take a look at what went on with NFP, right? So what's good? Good is something, let's use inflation and jobs, right? Good would mean lower unemployment. Good would mean higher employment. And so let's look at that from the good and bad perspective for NFP. The average hourly earnings ticked down a little bit, which can't be considered bad. Wage inflation was something the Fed wanted. Now it's a little bit of a problem. I know inflation's a problem. Who knew? Non-farm was a quote unquote miss. And not only was it a miss, all right, so it's a miss of what? Remember that a lot of folks will quote the 4-week moving average. So that means that they would be looking at the previous NFP that came in at, I believe it was, I don't recall off the top of my head, but they would look at the previous NFP and look at this NFP and say, hey, previous was, I don't know, 300,000 plus. This is 150. That's sloping downward, but that's not really the initial measurement. The initial measurement is the consensus was roughly 178,000, and you'll see a variance in consensus. So we need to basically a mean of the consensus, right? So if you take a look at Forex Factory, it was 178. We have to have just a number to use as a measuring stick. Were we lower than 178? Yes, that is bad news, right? Fewer new jobs in the stock market, the indices rallied. That's still the reality. And what made it even more so is the previous number. The previous number was revised downward. So there's revisions. I know you think they counted right. No, it will oftentimes be revisions. And in this case, the revision was fewer jobs and it came in at 297. So not only was the current number, meaning this is November's, this is October's number, but September's number was also revised lower. All right. Another bad news. If we want the unemployment rate to stay steady, if not tick down, it ticked up. That's quote unquote bad news. So you'll see here, bad news on all fronts, revision, current number, as well as the unemployment rate, those primary headline numbers. That's all bad. Equity markets rallied. Now, why would bad news be good news? Because, and it's a great question you asked, Drew, because if we're waiting on the Federal Reserve to stop hiking, we're there, gang. The Fed is not going to hike again. Target rate probabilities have been factoring this in, and target rate probabilities go both ways. On one hand, the target rate probabilities, which are basically the consensus of a futures contract that is in line with each one of the FOMC meetings, they basically make a bet, if you will, on what the Fed's going to do or what rates are going to be after the meeting is done. The target rate probabilities show more likelihood of a hold for the remainder of the year. If you've been following this show, if you've been reading Top Tier Outlook, you've known this for months. I'm just looking at the data, not prognosticating, gang. This is not about my opinion. Who cares what my opinion is? I don't even care what my opinion is when it comes to the market. We trade what we see, not what we think. We look at the data, not our gut and anything else. Pretty sure my lower intestines don't put on my trades. At least they shouldn't be, right? As soon as I hear someone saying this is my gut, I run, right? Gut has nothing to do with trading. And because that's the furthest we get away from process, from sequence, from confirmation, from scalable, time-tested things, right? I mean, maybe lunch didn't sit well. That's going to dictate my trades. Okay. So anyway, when I look at this target rate probabilities, the game now is, right? And it is a game, gang. The game now is whether or not the Federal Reserve is going to cut sooner. We've already come in from July to maybe June. Now, as we get through, say, the first half of this morning, I'm going to take a look at the target rate probabilities with my group in the Sector Secrets Mastery, which, by the way, you can check out over at sectorsecrets.com. We'll talk about the macro implications and whether or not those target rate probabilities are coming down. If we're seeing the Federal Reserve monetary policy and messaging and data suggest that they're keeping rates higher for longer, is hurting the economy, they're going to have to cut sooner. And it's just as simple as that. So great question. Thanks so much. Great way to kick it off. All right. Tim G asks, good morning. Hey there, Tim. When I review HPMR and DPMR setups, so by the way, for those of you that don't know the secret language, hourly price movement range and daily price movement range. These are volatility-based support and resistance zones. I often reference 68 to 73. No, that's my win rate. That's my preferred win rate window. 68% is the probability of the HPMRs. My personal win rate somewhere hovers between about 65 to 75, 68 to 73. So what does the percentage represent? So let's take my win rate part out of it. 68% probability for the zones of the hourly price movement range. So let me show you what I mean. Let me grab my drawing tools here. All right. So Tim, this is the, and I know you know what these are. That's the resistance. That's the support. So 68% probability, 68% probability that those will hold. That's really it. Okay. The 68 to 73 is a little bit different. That's my win rate. Does that mean it will hit T1? No, it's not about predicting. It's about saying that I've put in volatility-based boundaries, right, around price. And it is 68% of the time going to stay within those boundaries. So there's a high probability that the support and resistance levels are going to hold. And that lets us make a number of other decisions based on that range, right? That range holding. That's really what that is. So if I told you almost 7 times out of 10, this is where we're going to trade, think about the confidence and the scalability you have to make a number of other decisions about what you can do, knowing that price is going to stay in that sort of fenced in area, right? So that's the whole thing. All right, next up is do we want to short Tesla? All right, let's go take a look at what's going on with TSLA. So always it's first decision is whether or not we're going to trade a daily time frame, hourly time frame, 5-minute. I only trade 3 time frames, gang. I'm focused on only 3, and I don't use multiple time confirmations. I don't care if the 60 is agreeing with the 5. I don't care really if the daily is agreeing with the 60. Each one is an individual slice of psychology. So Tesla, the only thing I can do with Tesla on the daily standard is short. Yeah, that's the only thing I can do. Now, on the 60, different slice of psychology, I have some other choices, but I would still be bearish due to the fact that price action has, for the most part, most recently been heading lower, and we're trading below the 200 period. Now, let's change that slice of psychology to the 5-minute. 5 minutes all about buys. So it depends on what slice of psychology, and therefore also which ultimately which time horizon I really want to focus on. Today trading, today, tomorrow trading, that'll be a short-term swing. Today, tomorrow, maybe next week, that's a longer-term swing. All right. Next up is AMD and Nike. Same conversation, gang. When you're looking at a symbol, let me know what time frame you're looking at, and I'm happy to get specific to that. But I'm not going to touch AMD probably until Monday. Probably till Monday. I want that candle to settle down, see what goes on there. Nike is actually sitting at resistance. If I want to short the gold zone on the 60-minute, I could on the daily, but I can't. So here's the bottom line, Siva. If I'm looking at a vast sea, right, of stocks, I'm not going to prioritize non-trending names. When I'm going through, we could trade any number of hundreds and hundreds and hundreds of symbols. How do we choose, say, the 4, 5, 6, 7, 10, 20 that we might look at that day, right? So if I'm going to prioritize where my attention and ultimately where my capital will go, Siva, I'm going to focus on trends first, not on things that have had a sudden burst, because to me, that's coming to the party late, right? I'm going to try to find things that have been trending steadily, and that's going to be the priority. So not that those aren't great symbols, but at this time, probably not ones that would kind of get to the top of my priority list or watch list, right? And sometimes I think about my watch list as a priority list. What gets priority? Not just what I'm watching, but what do I focus on buying or selling? And by the way, just to finish that thought, make sure you have a priority list for shorts or puts and a priority list for buys or calls. All right, Robert asks, with this recent rally, are we back in position with swings 1 week to 1 month or viable again? They have been on and off viable through the month, Robert. I think we put on a handful in October. And for the most part, it's going to be where we have 1 hour and or daily trends, and it's looking like yes. But we've already done some, so it's not as if the swings are zero. It's really a matter of, can we get more? And that's what I do believe is starting to shape up, especially since we're getting better clarity from the Federal Reserve, and data is starting to really put the pressure on the Federal Reserve to just start being more clear about when they're going to cut, rather than being so coy about it. The less coy they are, the better longer term follow through we're going to get. All right. Next up, how do I trade a NASDAQ or NASDAQ option in a small account? So, Randy, I don't think small or large, but I can appreciate the question. What I try to do is think scalable. So, a lot of times traders are taking on small account strategies that don't scale. We don't want to be trading a small account forever, right? That's never the point, that we're just going to be trading a smaller sized account. The question is, how can I employ a scalable approach that will work for, say, a $5, $7, $10,000 account as much as it might work for a $50, $70, $100,000 account. So I never want to think specific to small, medium, large, Godzilla-sized accounts. That's number one. Number two is it depends on the size of the account. So what I usually recommend to my traders is not to go with the options on the futures, which, if you haven't noticed, and I'm sure you have, Randy, they're pretty expensive sometimes, even if we're looking at near dated options. So I prefer, and this is what I do, right? I'm always going to talk my book, right? Who cares what I think? It only matters what I'm doing, right? QQQ, because you can scale into a number of QQQ options. I'll give you an example, Randy. I think yesterday, and find out, ask yourself, would this be viable from a liquidity standpoint? And would this be something you're comfortable doing? So number one, NQ options are pretty illiquid. QQQ options are massively liquid with daily expiration. The other thing is your QQQ options are usually, I'll give you an example, I think our SPY options, just to give you an idea, playing an index option cost $170 per option. Right? 170. So now you ask yourself, in my small account, how many of those could I buy and not risk, if I were wrong in the trade, more than, say, 3 to 5% of the account? And so I think the QQQs are the better way to do it. Okay. All right. So let's see, what else do we have? And by the way, Wilkin says Tesla short, don't do it. No, I'm not looking to short Tesla. I think, Wilkin, my bottom line is, if I'm allowed to do anything with Tesla on the daily time frame, it's only a short. On the 60-minute, it's only a short. On the 5-minute, it's a long, right? And so you can't, the way I look at it is, I cannot paint a directional bias brush across all the time frames, right? So I got to find where the best clarity is on which time frame. So no, I'm not going to buy Tesla on a daily, for sure. But I completely appreciate where you're coming from. Would I focus on the long side today? I'm with you, my friend. Yeah, there's nothing really but that I can do today. And until that 5-minute looks like it's starting to exhaust, I won't even think about the shorts on the 60 and the 1 hour. So yes, it's really good to also think about, how do the different time frames contribute to each other, right? So once the 5-minute exhausts, I'm not going to try to short the 5. I'll then turn my attention to a 60 or a daily. So yeah, absolutely. Yeah, great additional info kind of on what we would do there. What are my thoughts on consumer staples? Keegan, on consumer staples, they're just trying to go neutral. I'd still be largely bearish. If we're going to see more clarity with the Federal Reserve going dovish, say by May, June of next year, I don't want to focus on utilities or the XLRE. So no XLRE, no XLP, no XLU longer term. I mean, day to day, it could be different day to day, Keegan, but I would focus on more risk appetite. But I'm mostly still bearish. Yeah, I'm mostly still bearish. JK, would I use hourly price movement ranges with other tools? Look, I will tell you, HPMRs will contribute, will give extra added insight into everything because most tools are predicated on price. We're looking at open, high, low, close. We're doing some sort of arithmetic with price. So if you take a price-based tool, like you mentioned with quant, you take QP and you add HPMR to it, they will work a little bit better together because now you're looking at price action from the quant pivots side and the hourly price movement range volatility. So, I think they will work together in that regard. Some things will be complementary, right? But I don't use the tools other than what's on my screen. So far be it for me to say this works and that doesn't work. I just use what I use, and you'll always see everything I've ever taught, anything we've ever put in a class, they're always going to be on my charts, because before something can make it to my charts, it's got to be vetted, it's got to be tested. And usually my minimum is a year, but most of the time they've been vetted and tested for years, multiple seasons of the market. And everything goes through seasons, gang. So you want to test something through multiple seasons. And then you say, okay, it merits being parked on my chart and staying there. Years and years and years. That is true. All right. As always, gang, thanks so much for joining me for Charts and Coffee. I will see you all on Sunday for Top Tier Outlook, 6 p.m. Same channels, different time. Be good to each other, gang.